Okay, good afternoon, everybody. This is your weekly take on the market. Today's March 11th, 2022. It's about 2:45 Pacific time. Market's been closed for a little bit. I will be your host. My name is Scott St. Clair. I am the manager of the Premium Product Group here at Investors Business Daily. Here's the disclaimer. I'm not licensed. Nobody at IBD is licensed. We do not make buy, sell, hold recommendations. You need to do the work on your own. Okay, so the drill is the same. We'll talk about the markets. We'll delve into the industry groups. Not a whole lot there. It's been the same for the last number of weeks. Then we'll go to some stocks, and then we'll do the quote of the week. So let's start with the markets, and let's pull up the indexes. And here is a chart of the NASDAQ composite. So not much of a day. The market actually opened higher on potential good news in the conflict overseas, and then it spent the rest of the day just grinding lower and lower. I think, let me pull up the intraday chart. Yeah, I noticed on my Thinkorswim platform, I have a tick charts that close every hour, and every single hour was red today. Just relentless selling or lack of demand. There just isn't any demand for stocks at these prices. And so they're searching for demand, and the only way to get demand is for the prices to go lower. Unfortunately, in the stock market, it's like a reverse effect. Lower prices actually decrease demand, I think, to a point. I know that when stocks I'm in go down, I have less interest in buying them. So it's kind of a strange world or strange phenomena, but it just was lousy all day long. So it just looks like the market's probing for some type of place where buyers and sellers can meet. And the problem is every day that number is, a couple of percent here or there. The volatility, I think the NASDAQ has had somebody said NASDAQ has had a 1% move every day this year. You can see these bars, they seem pretty large. So it's really bad. I'm actually, I do own a couple of stocks. I don't know how they will act if the NASDAQ makes a new low, but I just feel like if we're going to have any kind of tradable rally or bounce, you're probably going to have to undercut this low. I really would like to get that 3 waves down. I know I talked about it earlier. I just don't think this is enough of a wave. There's just not enough damage there. It's not going to scare anybody. But this is damaging. This is damaging. And if we undercut those lows, then you'll maybe you can create some fear. The S&P, and we might even be able to get like a positive divergence. I would love for the NASDAQ to undercut the low, but the S&P not to. That would be a positive divergence. I know the bull bear numbers, I think I have a chart on that, are saying that the sentiment is pretty bad, and it seems bad. And if you're watching the tape, it feels bad. Like I'm not even in hardly in it. And there's a saying, I don't know who coined the phrase. Maybe it was Dennis Gartman, but I'm flat and I'm nervous. It's just when you're watching the market just bleed to death day after day after day, it can affect you even if you're not getting hurt. So the market could set up for some type of rally, but I just don't think we get anything of substance unless we get a really bad day or two, some kind of shakeout underneath these lows. ARC, for example, I mean, it just makes a low, tries to go up, makes another low, tries to go up, makes another low, and it's just given back. This is hard to see because this is a monthly, but that's the COVID March 2020 low, and ARC has given back all those gains. Now, I don't know if I mentioned this on the videos or if I mentioned on IBD Live, but really bothers me and has for a while that a lot of these stocks, the leaders, this is the same thing, looks very similar. Shopify have given back all of the COVID bull market gains. Here's PayPal, Twilio, March 20, not quite, very close. Square, though it did bounce off of that right there. And I could go on and on. Docu, it's just there is everything that was good in 2020 is awful now. And that's partly how the market kind of, changes in new leadership, which is why we have sell rules and why Bill would say, roughly, I don't know what the statistical number is, but as a general rule, the vast majority of stocks that led in one bull market will not lead in the other. You need new merchandise. So these stocks, some of them, and based on history, a lot of them are not going to come back. Can Zim go from 100 to 130? Sure, but it's never going to be a leader. It's not going to be that type of leading stock like it was in this. And the damage is tremendous. Oops, is it Wayfair? What's the ticker for Wayfair? W. Here's the March. Now, this is just total extreme, like worried about going out of business. So you have two extremes, one here and one there. And so the market's kind of meeting in the middle. So back to the indexes, the fact that the best stocks have gone all the way back to the COVID lows tells me that that's the NASDAQ. That's not impossible for us to go back there on the index, which is another 28% or so, somewhere around that. That would not surprise me. I don't know what the probabilities are, but they are not zero. The probabilities are not zero that can happen based on the fact that all the other stocks have. So, that's kind of a worst case scenario. The way we get out of this bear market is twofold, is either time or price, or a combination of both. That's how bear markets end. Let's go to the slides. This was a really cool slide that a guy tweeted, bear markets. And the main thing for me is the duration. The March 2020 was a total outlier. Now, there's not a ton of data points here. You're looking at what, 9 or 10? But the March 2020 was a total outlier, unprecedented move to the upside, trapped everybody out on the way up. So maybe this one will just trap everybody on the way in, on the way down. It just feels like there's nobody to sell to if you're an institution. One of the big advantages that we have is we can get out if we want. So percentage wise, we're not anywhere near these. Duration wise, we're not anywhere near them. Although someday I'm curious what the history books will date the beginning of this bear market. Most people will use the top of the indexes, but I really believe that this bear market started much sooner when, there in March of, or February of 2020. I'm sorry, February of 2021. So that's when ARC peaked. I think LAGWX peaked then, which is Lord Abbott growth. I looked at a couple of other funds and in ETFs. T. Rowe Price New Horizons, just incredible fund. Look at the consistency there. In the bull market, always in the best merchandise. And, that peaked November of 2021. Fidelity Contra, November of 2021. So November, December, so we'd be 5 months into it if you use that as an indicator of when it started. Back to the volatility. Where is the source on this? Bloomberg, I apologize, I forgot the source on this, but it was somebody on Twitter who posted it. And if it's you, I apologize for not giving you credit. That wasn't my intention. But this was the S&P a couple of days ago, I believe. And I think there were 8 rallies, higher or lower of 1% or more. So it's a very hard market to trade. I hear a lot about people saying, oh, I'm using tight risk control. And but that's not possible in this market. It's not possible intraday, and it's really not possible overnight. If you're short the market, you have overnight risk that the conflict is resolved or something like that, right? And you would not want to be short, even if it was for the short-term rally on Monday. If the conflict's resolved, the stocks are going to go up. And if the conflict's not resolved, it feels like the market's going to be bad on Monday. It's the way it closed. So there's just so much risk. You can't manage your trades with, tight stops, so to speak. I don't think. Intraday, well, you can have a tight stop, and if you had bought or sold the S&P, you could have gotten stopped 8 times trying to trade that. So position size is key. Probably if you want to be in there, you really want to reduce your position sizes. And this hasn't been that bad a year for resource, for oil and gas type stocks, for energy stocks. There's been places to make progress for sure. It's the growth area that's really, they just went way over their skis, and it just feels a lot like 2000, where just so much money chased that area, and now it's trying to find a way out, and it's a roach motel. They let them in, but they can't get out. There's no, I think if you remember when I talked, let me see what the next slide is. Let me go back to this slide because I want to talk about the over-ownedness of the market. I don't know if you know who the Tiger Cubs are, but they're basically hedge funds that have come from the Tiger family, which is a family, kind of like a feeder famous hedge fund. Anyways, these are all great hedge funds, and these guys are sharper than a tack, and they have tremendous AUM, lots of assets under management, and great track records, but they all own the same stuff, and rightfully so. When things are going good, who gets more money? The people that are doing well. How many guys in 2017, 2018 were putting money into energy related hedge funds? Very few to zero, right? Who wants to do that? And energy is going to zero, allegedly. So they have a lot of money, a lot of AUM, and they all gravitate towards the same names because they all have the same style. And it seems like everybody has the same style. So you can see they all pretty much all own Amazon. Oh, they do all own Amazon. DoorDash, Farfetch, JD.com, Facebook, Microsoft, Netflix, across the board, Shopify, Square. They're all in the same name. So who are they going to sell to? I don't know if you remember when I talked about the Swiss National Bank, like who's the buyer of last resort? If the Swiss National Bank owns, 5%, almost 7% of their assets as of December 31st are in Apple. 5.5% are in Microsoft, 3.5% in Amazon, 2% in Tesla. If they want out, who's going to buy from them? So you have to, and there's a reason I haven't owned Microsoft or Netflix or Facebook for years, and wrongly, until 6 months ago, 8 months ago, depending on which name. But they were all way over-owned to me. It just didn't seem like there was anything new about them. One of the things about CanSlim, one of the key letters is the N, the new product, new service, new idea, new company, new high, but coming out of a base. So these stocks just seem waterlogged, which is why the market's having a really hard time catching a bid. It just can't stay in a certain spot, and when it tries to go up, it meets resistance because there's sellers at ever higher prices as of now. That will change, and sentiment, like I said, the main thing, the good news is people see that, and people feel the same thing that I feel. It feels really bad. So that's usually a good sign for the market to make a change. Bloomberg, the scorecard, I don't use any of these like Williams percentage or Rex oscillator or DMI or anything like that, but technical strategies have been performing pretty well this year, or or even some of them that aren't performing that well are definitely outperforming, quote unquote, buy and hold. So finally, if you had, some type of sell strategy, it's finally come to fruition. Okay, so let's talk about the industry groups. Let's pull up MarketSmith. All right, let's pull it. Industry group rank. All right, number 1, oil and gas. Number 2, oil and gas Canadian. 3 is energy coal. You get the idea. It's the same. There's nothing different here. The chemicals, agriculture, CF, NTR, Mosaic have made huge moves. Mining, metal ores hanging in there okay. The only thing that's not related to energy, because truly chemicals, agriculture are energy related, is media periodicals, but there's only 3 stocks there. Medical, wholesale, drug supply, I don't know that group really well, 7 stocks. Retail, department stores, mining, gold, gems. So there's not a whole lot here. And this oil and gas group has made a big move short term. It feels a little bit like it needs a breather. But if you look at really long-term charts, it could be just the beginning of a secular change. I don't know, and I don't like to think that way, because if I buy it and it goes down in 5 days, I'm going to sell it if it hits my stop. I don't want to have this idea, oh, oil's going up for 5 years, why am I selling it after 5 days? Because I don't know that oil's going up for 5 years. So I get myself in trouble when I do that. So I just look day by day, day by day. I like to think about this kind of stuff, like I think about like uranium and the grid. Our grid needs a lot of work. I just don't know, based on what I read, I'm not an expert, but based on what I read, how we can have everybody in the world driving around in electric cars based on the infrastructure that we have. We definitely need more electricity, and the only way to do that, or the best way, I think, according to the experts and the way the chart is telling me, because if it's going down, I don't care what they say, is something like uranium. Anyway, so I think like that, but I manage my risks day to day, if that makes sense. So stocks to watch. Let's go to one that jumped out at me, METC, which is coal. I don't think I've ever done much in coal stocks. I don't know, maybe it's I've got that kind of bias. It's dirty energy, so I've never really done a bunch in coal. But man, coal has been one of the crazy good stocks. Areas. I think the buy point was right there. I wouldn't buy it right here. I think the buy point was this day, somewhere in there. And if you missed it, you had a couple of chances on the pullback. It's just coal. I've never done much with it, but the earnings and sales sure are really good. So that stock jumped out at me. As far as long, since I mentioned it, we might as well look at uranium. I see that it's building a cup, and honestly, I'm not going to wait for 104. I think it's a double bottom. So I think the pivot was 84, which is right at currently, it looks like. But anytime there's a double bottom, I'm always looking for, the Jesse Livermore shakeout undercut. So when it undercuts this low and comes back up through the low, that's how I will buy it, by a certain number of points. I think I might have tried it here and got stopped out. I'm pretty certain I did, but then I'll try it again there. And somehow this was really tough, because that was the attack on the nuclear reactor in Ukraine. And uranium opened down, and I had my orders to sell. And I honestly, I think I did reduce some at the lows, now that I remember, because I was fearful. But it never made it. It opened on the low and just kept going up the rest of the day. I never had to do any more selling, and so I was able to survive a little bit, and that's okay. That doesn't bother me that I gave up some at the low. Somebody has to print the low. It's usually what I'll do if something gaps down. If I have 1,000 shares and it gaps down, I might sell, and I think I need to reduce. I might sell 200 shares and then wait, see what happens. And if I sell 200 at 70 and then it goes 69, 68, I might sell another 200 at 69, 68, 200. I'll just keep getting that, selling it until I'm completely out. And then sometimes I can survive a shakeout. Now, if it just keeps going down, I would have been better off hitting the bid on the open, but that's really hard to do psychologically, right? Because, it's down, I think it was down 4. And, I've got X number of shares in all my accounts. So it's hard to just hit the bid in a situation like that. It's not hitting my stop either. I'm just giving back all my gains and then some. Maybe I was underwater a little bit because I will add a little bit on the way up. But it hadn't reached my stop, but I have to respect the fact that, gosh, something's wrong. It's opening down 4. So that's how I usually handle gaps. If I'm in something that gaps down, Netflix, I'm just going to start hitting the bid. And it's highly, highly unlikely I would ever be in something like this because it's below all of the moving average. But is Xilinx still in the database? It's not. Since I'm on the subject, I'll go with the lesson, right or wrong, whatever it's worth. 221.20. It's going to look really bad where I sold Google. Ugh. Okay, so I was in Google here. And where did I buy it? Here. I don't remember, but it closed 1296. I think that's pretty much all-time highs at the time. Yeah, and they announced earnings, and it gapped down. And I started doing some selling, and then the next day do some more selling, the next day do more selling. So in this case, I'd have got a better price if I just hit the bid on the open. Xilinx, the same thing when it gapped down right in this same time frame. Xilinx gapped down. I had both of them in my institutional account gapped down like that, which is really brutal. But within 3 or 4 days of each other, all the gains wiped out in one day. But that's what happens on earnings. You take the good with the bad, and look, Google is much, much higher now than this price. But I would have never survived this move, and then it'd be Puke City here at 1,000. So I'm better off taking 1,200 or 1,180 or 1,160, whatever I'm doing, and I can always buy it back. I can buy it back at 1,250. I know that's 50 points higher. That is more, but you have to understand the psychology of this game. So important, the psychology. I know from a math standpoint, it was a bad sell because I bought the stock back higher. But from a psychology standpoint, I just saved all my mental capital on this. And who knows, maybe I used the capital in this time frame to buy XYZ, which went up. I don't know. But I think it's underrated in the academic world, the fact that selling and taking a loss protects you not only from more downside financially, but a lot of times when I'm in something that's down, it just eats at me. I watch it all day. I'm staring at it, begging for it to go up, and there's just a whole weight is lifted off your shoulders when you sell it. Even if you sell it for a big loss, it's just like, okay, it's gone. I cannot lose any more money in that name, and it just you'll just feel like literally like having a sandbag on your shoulder of 30 pounds. You've been hiking a rucksack, and it's just gone. It's hard to explain, but a lot of you probably know. Okay. I don't know how much time I have, but I wanted to discuss why we have sell rules for individual stocks. I think I've talked about this, but it's just the math is so cruel. Now, if you bought EPAM here at 20, congratulations. Very few did that still own it that aren't like, founders or something. If you bought it at 80, even at 200, you did super well. But you have to remember, let's say you paid 80 and you put, let's make the math easy for myself. You had, you bought 1,000 shares, 80 grand, and you turn that 80 grand into 600 grand. That's a lot. That's a lot of money. And now you've turned that 600 grand into 200 grand. Well, you turned 80 into 200, but again, that mental capital of this is just brutal, especially the waterfall decline and how fast this happened. So I know what I would be thinking about is I've lost $400,000. That's what I would be thinking. I would not be thinking I'm up 120 from 80 to 200. So, if you sell it at 300 and then you watch it go to 600, it's super frustrating for sure. But I don't think it's as frustrating as if you didn't sell it and you watched it go here. That's why I like to sell them on the way up and take the profits when the going is good, because you run into these quote unquote once in a lifetime bear markets that seem to be coming around so often. And you're just getting, if you go and look at some of these names and these waterfall declines on their monthly charts, it's really disheartening if you're in any of these names, like a firm, which was supposed to be the next great thing. It's giving it all back. What's the other? Oh, UPST, the other favorite. I don't know. It's held up better than most, but come on, that's 400 down to 100. That's a long way. So it's ugly out there. And so Facebook, it's giving back. It's just having a hard time. There's just no buyers. And I think the problem, going back to the over-ownedness, is all the hedge funds. Do they own Facebook? Check. What about all the mutual funds? Do they own Facebook? Look at the IBD Mutual Fund Index. Check. Fidelity Contra, I absolutely think Will Danoff is one of the best mutual fund managers ever. He has 10% of his assets in Facebook, and he's made a fortune on it. But he's if he wants out, he's trapped. He's trapped. There's nobody to sell to, because all the hedge funds already own Facebook. They already own Netflix. So they already own Netflix, as you saw from that previous one. And, this is I think they call it the Ackman bounce, because Bill Ackman bought a big chunk of Netflix, and the Ackman bounce lasted a total of 3 days, and now it's, at new lows. So you have to respect price in a bear market, and the stocks that you think will hold up will usually go down at the last. So, like, I think Tesla is the poster child of the bull market. Was, I don't know percentage wise if it was the best stock, but it had to be in the top 10. And it's holding up really well. It's kind of reluctantly going down, it seems. I think that the end of the bear market will probably be when Tesla finally gives up. If it were to roll over, that would be a sign to me that, okay, we're getting close, because now they've given up on the best merchandise. Food for thought. All right. So I feel like that was all that I wanted to discuss. So the quote of the week, I don't know if you know who Michael Burry is. He was played by Christian Bale in the Big Short movie. He made a bloody fortune in the subprime crisis, and he closed his hedge fund after, and just said he spiked the football. Awesome for him. And he said, I'm just going to run my own money, and he closed down his fund and gave everybody back their money in many multiples. And he's very eclectic, amazing thinker. He was a doctor for a while, and then he had a message board on Yahoo where he was giving stock picks. And his style is very different than mine. He's deep value, etc. But I don't, it's not about their style, it's about the way they think. I think all the great investors that I read about, that I follow, they all kind of think the same way. I really believe that as far as risk management, trying to be a pig. If you feel like you have something, let it run, let your profits run. All those sayings that have been around forever, they all follow that kind of style, that process inadvertently. But he said something I think is very, very important. If you're going to be a great investor, you have to fit the style to who you are. Remember when I was talking about the EPAM? I'd rather sell it at 300 and watch it go to 600 than watch it go from 600 to 300 and sell it. If I sell it at 300 and watch it go to 600, it's frustrating. That's happened to me multiple times in my career. I've been trading a long time. That would bother me, I guess, a little bit, because, gosh, I wish I still had that. But if I was in it at 600 and let's say it just gapped down to 300 one day, I would get the same price, right? The money would be the same. Let's say I paid 100 for it and sold it at 300, whether it was on the way up or on the way down. Then 200 points is the same net, but that would not feel the same way to me. That would hurt. What do they say about losses? They hurt. People feel losses twice as much as gains. I think it's actually probably larger. I don't know what the psychological test will say, but that would really, really bother me. So knowing who you are is very, very important to being successful in this game. At one point, I recognized Warren Buffett, though he had every advantage in learning from Ben Graham, did not copy Ben Graham, but rather set out on his own path and ran money his way by his own rules. And that's the same way I feel about Can Slim. I've been immersed in the program for 25 years. I've been to countless paid seminars with Bill O'Neill and David Ryan. And in the last 12 years, I've been to every single seminar and presented at seminars and heard Bill speak 100 times at least. And I've long ago, when I say long ago, I mean maybe 8 or 9 years ago, I just decided that, I cannot be Bill O'Neill. I've got to be myself. So I think it's very important for you to learn what your style is. Make sure that it's replicatable, scalable. These are words that I hear a lot when I was in the institutional side. What are you doing? Can you repeat the process, or did you just get lucky? Did you just catch a bull market and just get lucky? I think about ARK. Is their process repeatable, or did they just get lucky? I guess we'll find out in the next up leg. But a lot of mutual funds go through that. Let's see here. The Hebner CGM FX. Is it C? Yeah. So this is the CGM Focus Fund, and I think somewhere in here, Ken Hebner was the manager of the year, of the decade, I think. I think that was it. Fortune named him the mutual fund manager of the decade, and rightfully so. The guy was unbelievable. He's loaded up in home builders in that bull market. He had a big position in Petrobras when the whole thing was the BRICS, Brazil, Russia, India, China. He did amazing. And then it all fell out and he got hit like everybody did in this crisis, but he hasn't come back. The fund is still 45, still roughly 10-15% off of the highs in 08. Whereas if you look at the NASDAQ, what's it done since the 08? Where's the 08 low? Bear with me here, right? Incredible. So, repeatable, scalable. If you can, you can go on, you can double $1,000 in the market or 10,000, but can you do that same thing with 100 or 1 million or 10 million, right? As you go further up the food chain. So the reason I do this is because I'm on IBD Live. The reason I brought this up is because I'm on IBD Live and talk about things that I do openly, honestly, And I don't have any misgivings about things that I do. The reason I do them, right or wrong, I make plenty of mistakes. I promise you, I probably make the most mistakes of anybody, but it's because I do this because I've learned that it's right for me. It's my style. That's the way that I prefer to trade. So keep that in mind as you develop your own style. I know a lot of people, especially in a bear market, are probably going to be struggling. Find out what you do really well, and also find out what you don't do so well, and stop doing that. Okay. All right. I appreciate your time. This one ran over pretty long, but gosh, the market is just so dynamic. There's just so much on my plate to think about each week. I'm going to butcher the saying, but there's a great saying. There's what is it? Help me out here, somebody. There's weeks where nothing happens, and where there's decades where weeks happen, and weeks where decades happen, or something like that. But in other words, there's just a lot going on in the markets, geopolitical and macro and everything under the surface. It's just a crazy time to be involved in the markets. All right, let's go to contact information. Reach us at marcusmith.com, 800-831-2525. Have a great weekend, everybody. Thank you.